Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, finally, the all-important Tesla Economist 2022 price target. To be honest, I'm not overly excited about the price of the stock this year. I think this is just going to be another waiting year and not a massive breakout year. But you never can tell. I mean, just from that Hertz announcement, the stock jumped a million miles. But I think Tesla is being very much valued on its actual performance now, rather than what Tesla say they can do. In other words, the market is placing a lower PE ratio on Tesla. So let's go through it all and see what we can come up with. How are we going to work out an estimate for what Tesla's stock price might reach by the end of the year? Oh wait, just to clarify, when I say a price target for 2022, I actually mean when we get the final financials for the year, so likely closer at the end of January 2023. I think we need the entire financial year to base the valuation on. In other words, we will be factoring in the 2022 Q4 earnings report into our valuation. I'm going to make an attempt to estimate deliveries for 2022 for each quarter, along with an estimate of Q4 2022 earnings and the price target I expect. I've also created a new account in Patreon that includes forecast spreadsheet downloads like the ones you're about to see. Alright, well, let's work out what Q1 deliveries might look like. I don't want to go into too much detail as to how I arrived at each number for the deliveries, as we have a lot to get through. For Q1, I will go into much more detail as we get closer to the end of the quarter. As for Fremont, things are gradually expanding there, and they plan on 50% production improvement from last year, so expect some growth there. China will be surging ahead though, especially if we're already seeing production numbers in almost 70,000 for January. I don't think the two new factories are likely to make any deliveries in Q1. It's probably easier to save them all for Q2. If they did deliver any vehicles, then it would still be a relatively small amount anyway. In the deliveries estimates for Shanghai and Fremont, I'm just going to expand them quarter over quarter. We've been told to expect at least 50% growth from these factories for this year. We have no reason to not think this isn't possible. We know that Shanghai has already seen run rates of over 80,000 units a month from the Model Y line alone. We know CATL are serving batteries from just up the road at a new facility with a huge amount of battery capacity. Tesla is still expanding phase 3 of Shanghai too. These sides of the business are already flowing, therefore we shouldn't expect too much deviation. It's really going to come down to me trying my best to estimate what the run rates of these new factories will be. I've researched the rate at which the Chinese factories were ramping up and done my best to estimate how fast we expect the new factories to ramp up. But the new factories have been testing the production line for months. It's not like they're just starting. They've had much more time to get everything ready and prepared for the opening than they did in Shanghai, implying that when they do officially open, then it should start at a much faster run rate than the previous openings. Between the two factories, I can't really say which one would ramp up the fastest. However, it is starting to look more likely that Texas may be the first to open. Given this, I'm going to have them both starting deliveries in Q2. However, Texas starting sooner will mean more deliveries. Of course, we can't even be sure Tesla are going to open Berlin in Q2. I know this feels a bit of a blow to Tesla's progress, but is it really? Tesla are chip constrained, so whatever chips aren't being used in Berlin may be used elsewhere anyway, so hopefully it doesn't delay much in the long run. Therefore, in these estimates, I am in a sense placing in the amount of vehicles I think Tesla have enough chips for from each factory as they ramp up. And if they don't hit these targets anyway, then the chips from these cars can likely be used elsewhere. Remember, Tesla are not manufacturing nor battery constrained. I think Q2, Texas, could start at around 10,000 units, especially given all the testing they've had now. This is actually a pessimistic ramp up when compared to Shanghai, given how much more experience Tesla have had since, and the new production processes. In fact, I have no doubt the run rate is significantly faster already. I think it's more likely that it's going to be the 4680 supply and production that will be holding back Texas, but it's just too early to speculate yet. Same for Q3. It is reasonable to assume Tesla have reached a run rate of around 10,000 units a month by halfway through the year. In Shanghai, Tesla hit 10,000 a month capacity with the Model Y within 3 months. I know we are chip constrained here, but would it not be unreasonable to think that possibly the new factories will get priority with components due to the margin being so much higher on these cars? And given how important the ramping up of these factories will become. Again, I have no doubt the factories can ramp up this speed, but the 4680 batteries may not be able to keep up, and Tesla may not have a 2170 fallback plan for Austin. This gives us a total estimated deliveries for the year of just under 1.7 million vehicles, which may not sound as high as some of you were hoping, but it's still around an 80% increase year over year, and remember this is all because of chip shortages. Okay, so now we have to work out the ASPs for each of these vehicles from each of these factories. I've adjusted the average selling prices to factor in the new price increases from the existing factories, although I've not included any more additional rises for 2022. I'm also going to raise the prices for the Texas 4680 version. I may be wrong, but it's not a major figure. I'm keeping the Berlin Model Y price fairly similar to what it costs to buy in Germany now. I'm not sure Tesla Germany will be feeling much benefit of the 4680 batteries at all this year. Perhaps they will save it for next year. Thus, we won't have all the added benefits of new technologies in Europe like we do from Austin, and thus the Berlin version of the Model Y will not be as valuable and may not warrant as high a price tag. However, there's still going to be a lot of new great additions to it over the Shanghai versions, which are of value. Not to mention, Europeans would likely see more value in a vehicle made in Germany rather than China. Although I'm not raising the price, the margin will still be a significant improvement due to no tariffs from China and all the transportation costs. Alright, when we total all those up, we are at auto sales revenue of $28 billion for Q4. We can see that revenue is 76% higher than that of the recent Q4. Even though deliveries were only up 66% for the same quarter the previous year, the discrepancy in revenue and deliveries is mainly due to price rises and extra supply of the higher priced Model Y long range. We have an overall ASP of over $55,000. With a 15% adoption rate and about half of FSD income as deferred revenue, FSD comes in at nearly $500 million revenue. Yeah, it's not a great moneymaker until the adoption level really starts to increase. And of course, not having the deferred revenue anymore would help a lot too. At least not a lot of income relative to the order revenue and huge profits they generate. I would hope that by the later part of this year, Tesla are back to producing good margins, and as they hit volume production on these new factories, then perhaps they are indeed reaching some decent margins, especially as there is less of a chip shortage by then, and 4680 batteries have ramped up. Remember, all the prices have increased, which gives us more margin, along with more advances in Fremont and Shanghai, producing further economies of scale, thus reducing costs, and further increasing margin. And then the new factories with the new processes. No more tariffs or import costs to Germany, Texas using 4680 batteries. Although the 4680 batteries may take a little while until the full value is felt when the yields and production rates are further improved, which could occur at the end of this year. Anyway, I think 32% gross margin is possible for all of those reasons. This brings total auto gross profit to $9 billion for the quarter, an 85% increase from Q4 2021. I imagine Tesla's energy business has grown quite a bit, what with the new Megapack factories and CATL ramping up more LFP batteries. I'm going to place energy revenue 3 times higher than the last Q4. Services and other should have grown a bit also, especially with so many more cars coming into the fleet. This brings total revenue to $32 billion just for the quarter. As for costs, energy may be making a bit of a profit by this stage, what with the lower cost batteries from CATL overusing Panasonic's 2170s. Therefore, I'm giving energy a reasonable gross profit. I think services will still be a bit of a loss, just whilst the new fleet is still growing at such speeds relative to the existing. For OPEX, I've just about doubled R&D. Tesla's R&D budget is always relatively low considering what is being achieved. It seems that Tesla spend money in R&D incredibly wisely. I feel like $1.4 billion is probably on the higher side, but Tesla may have a lot more research on their plate at this stage. SG&A, it might surprise you that I'm keeping the same, even though we have expanded so much further. Well, if you recall, a lot of the SG&A from the last Q4 were one-off expenses. It should have been much lower. I'm just expanding it about 50% of what it should have been. All of this takes Tesla to an insane operating margin of 20% compared to 15% in the previous Q4. Anyway, after tax and everything else, we're at a net income GAAP profit of $5.5 billion, 137% more than the previous Q4, despite only 66% more deliveries. It just goes to show how economies of scale are kicking in more and more, and this will be something we continue to see, very much so when Tesla ramp up the new facilities, but even more so when 4680 batteries hit higher run rates and better yields. This also equates to a diluted EPS of around $4.85, again an increase of 137%. Now, if earnings are up almost 2.5 times, then one would think that, in a sense, that means the PE ratio should be down by also 2.5 times. The earnings figure annualized takes us to over $22 billion net profit. There are other reasons to boost the stock too. There could be some major breakthroughs in FSD, perhaps even enough to push the stock somewhat. We were also told there'll be a new factory location announced later this year. We don't have any new vehicle models being unveiled or launched, but we might have a new battery reveal or HVAC reveal. Anyway, these could all add a bit of a boost to the stock price too. With all that being said, I would like to place a 70 times multiple onto the annualized earnings. 70 times 22 comes to $1.5 trillion valuation, or about $1,500 stock price, which is my official price target for the end of January 2023, aka my 2022 Tesla price target, $1,500 stock price. Or not far off about double the stock price at the time of this video. All of this with deliveries up 66% from the previous Q4, revenue up 80%, a further 5% increase in operating margin, and 130% increase in earnings. Relative to where the stock price is sitting at the time of this video, it's not far off doubling your money in a year, which still sounds good. FYI, this target price is only 20% higher than Tesla's all-time high, despite almost 2.5 times as much profit. In this forecast, we saw a massive jump in profit, not too far off 2.5 times more profit than the previous Q4. If a company is still getting close to triple profits from a year ago, it is very impressive. But for a $1 trillion company, it's unbelievable. Truly though, the most astonishing part of this is that this will still be with all the chip shortages. This constraint is not so much to do with any internal issues, it's an unfortunate macro issue. Yes, we can only imagine what size a company Tesla would have been by now had it not been for COVID. But I'm not entirely sure COVID has actually had any long-term effect in slowing down Tesla too much due to the 4680 battery production not being overly affected, or at least not in too major a way. Remember, ultimately, that batteries are the bottleneck. If the battery production or progress has not been too affected, then eventually the rest of Tesla will catch up to the battery supply. Prior to the earnings call, I'd actually been hoping Tesla would have hit 2 million deliveries this year. There were times when I thought even over that. Although I fully believe Tesla are capable of that production capacity and a whole lot more, that is not the bottleneck this year. It's the chip shortages, which doesn't have too much of a reflection on the success of Tesla. So this year will be a distracting year to the true success of the company. 2023 is looking much more exciting for the stock price. Personally, I'm going to use this year to accumulate my positions further in the event of potential dips we might see before the stock breaks out again. I think I will keep this forecast as a work in progress and probably update it every now and then when we get a better idea of how these new factories are going and the 4680 production. This year is predominantly all about how those go. I also look forward to hearing all your feedback on my numbers. Of course, I want to hear all your price targets too, and your delivery and profit forecasts for the year. And don't forget, you can download this spreadsheet from Patreon. This was all based on what I am inferring from the way Tesla is behaving, which would be based on their chip allocation, due to that being the limiting factor. I believe Tesla's manufacturing run rate is possibly 1 million higher than this again. Therefore, this is not too much to do with ramping or factory capacities. Chips are the scarce resource here. Anyway, like I said, this is a model that we can work from and refine and draw other inferences and models from too. Again, let me know your price target for the end of the year in the comments. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.